month's national real estate trends update. Really appreciate you guys joining us about everything that's all the good, the bad, and the ugly that's happening in the real estate market. So I'm Nick Elder with Ironton Capital. I'm joined by Lon Welsh with Ironton Capital and Joe Massey with Synergy One Lending. How you guys doing?
Great.
Lon, why don't you provide a quick overview of yourself and the investment team at Ironton Capital?
Yeah, we've got 3 people on the investment committee at Ironton to pick out the investments. My background is I worked as a strategy consultant for 8 years at Deloitte and Accenture, and then I've been in real estate for a couple decades. I built a real estate brokerage called Your Castle Real Estate that grew to be the largest in Colorado, and I sold that to private equity in 21. Started Ironton Capital right after that, and then I've been a real estate developer and landlord for a couple decades as well. Brent Geyer, CEO, deep expertise in land development and just development in general. And he was a CPA at KPMG prior to starting off his real estate career. And then Richard Landry came to us via Goldman Sachs, and then he was chief investment officer of a $2 billion family office prior to coming to join us. So really well-rounded team with a lot of different skills. I'm just really grateful to be able to work with these 2 guys.
Awesome. Well, Joe, Lon, you guys want to kick it off here?
I'm going to let you guys drive, and I'll just be here to help with questions as you get stuck.
All right, Lon putting us to the test.
Yeah.
All right. It's like the teacher, seeing if we can do a good job or not. And
I know you do a better job than me.
That's off. Yeah.
Spoiler alert, we won't do very good. So my name is Joe Massey. I'm with Synergy One Lending, and really excited to chat with you guys this evening. I really like what Nick said. We're going to go through the good, the bad, and the ugly. You can see our 3 faces on the side. You can decide which one of us is good, bad, and ugly, between myself, Nick, and Lon. So what we're going to start with, guys, is we're going to talk about consumer confidence. And I really follow this metric very closely, as I know Lon does as well. The very first slide here we have is consumer sentiment. And over on the far right-hand side, if you've been joining us for the last few months, you'll remember late 2025, consumer sentiment was at a near all-time low. We've actually seen that begin to rebound over the last 5 months. We've seen a little bit of improvement in interest rates. Tariffs have become a little more normalized, if you will. They're not scaring so many folks. Headlines have kind of eased up on economic pressure, and people are kind of just generally feeling better. Another thing that I think is part of this, and we see this a little bit with the sawtooth pattern in this, it's seasonal. People kind of feel down in the wintertime and they start to feel better, which leads to really good spring selling activity. So we are seeing consumer sentiment improve, which is something that I really enjoy. But we do see, sorry, I clicked too many times. There we go. We do see that consumers are still pessimistic about the market for buying or selling a home. If you look on the far left, you see a low percentage of people think that it's a good time to sell. And on the far right, a very, very low percentage of people think that it's a good time to buy. That's something we're going to talk about as we go through the slides this evening. I think it's a very good time to buy.
Yes.
I think there's a lot of metrics that point towards that. Let me pause before we dive into any of those metrics and take a 2-person survey. Nick, is it a good time to buy right now?
100%.
Lon, good time to buy right now?
Yeah, there's more inventory to choose from. The rates are down by more than a point versus a year ago, and there's a lot of sellers that need to sell, and you can negotiate hard to get a good deal. So if you need to get just like a super special house, you may not have the negotiation leverage, but if you are flexible to have a kind of house, you can find 6 that'll meet your needs, write hard offers on all 6. Somebody's going to cave into your request.
Yeah. We're going to talk a little bit about that. I think we have a slide. Seller concessions are up, which is good for buyers, not as good for sellers. But seller concessions are up. Price negotiation, we're seeing a lot more sellers come off of their list price. However, we're getting into the spring selling season, and we are seeing some competitive offers. So exactly what Lon said, if your buyer is not terribly picky, there are good deals to be had. If your buyer needs something very, very special, they may still have to pay list price, maybe even above. But I really like this chart because I think, especially if you're an investor, there might be some good opportunities out there right now. Now, inflation, this is steady. We have seen it increasing over the past, 2 or 3 months. I think we're going to see that increase in some of the metrics coming up with the price of gas that has gone up. So the price of energy is going to impact this as we get into the spring. Unemployment. Despite some government layoffs, unemployment has been really, really steady. Not as low as we've ever seen, but still very, very low. Yeah, I was going to say pretty darn close. I think anything below 5% is pretty positive that the economy is just chugging along. Would you agree with that, Lon?
Oh yeah, when I was in college and grad school, like anything under 6 was considered to be excellent, and I'm amazed that we've had a couple decades in the 4 to 6% range. It's just unbelievable.
Yeah, it's been really good, and that leaves a little bit of a challenge for the Federal Reserve, which we're going to talk about. I think they're actually meeting tomorrow. Very low likelihood that interest rates are going to go down. Pretty high probability that interest rates are going to stay the same because unemployment's really low. Inflation not quite at their 2% target, but right now they're very much in a wait and see mode, which frankly I really agree with.
Yeah, I do too.
Yeah. The economic growth at the end of 2025 was weaker than expected. We did end up with positive GDP for 2025, but it was kind of off right there at the end of the year. I think first quarter is going to be positive GDP again. I think we've got some slides we're going to talk about. Are we going to have a recession? I would say overwhelmingly not very likely. However, job growth is slowing down. And that's where you see this is the number of new jobs that are added every single month. We're not seeing as many people getting new jobs as we might like. But again, with unemployment remaining really low, I don't see any major concerns on this. But do people worry about an upcoming recession? Nearly 2 out of 3 Americans think that a recession is coming. And 74% of Americans admit that world news and current events affect their financial decisions. So this is something that I want to pause on, that I think we really need to be maybe an alternative news source for folks that, hey, you know what? You think a recession is coming. Join us on one of our national trends calls. We'll show you all the reasons why we think a recession is not coming and why now might be a good time for you to buy while everybody else thinks it's a bad time to buy. So this one, I think, gosh, if we went back and we looked at this for the last 2 years, I don't think this stat has changed. I think for the last 2 years, 66% of people have said, oh, there's going to be a recession in the next 12 months.
Yeah, people have had this dark cloud over them for quite a while, and I think that's linked to the negative consumer confidence trend that we've seen for a couple of years, really since post-COVID and since 2022 when the interest rates really rose. We're rolling on 30 months of this black cloud. It'd be nice if it'd go away.
Yeah, it's kind of like for those of you that have been around with Lana and myself for 15 years, you remember the shadow inventory question? Yeah. This is kind of similar. When are we going to have the shadow inventory? When are we going to have the recession? Never. Just make your decisions based on the best that you can do for your personal situation. Because this is the counterpoint. 75% of economists who actually study this stuff do not expect a recession in 2026. The forecasts are for GDP to grow between 1.7 and 2%. And a big driver of that is a lot of certainty around tariffs. Now, this got thrown off a little bit with the Supreme Court ruling a couple weeks ago, but I think tariffs are probably here to stay in some form or another. And it's become kind of the new normal that people are understanding. Things are a little bit more expensive. You know what? My apartment is still too small. I still need a place to live. I'm getting married. I'm having a baby. People are kind of moving along with life. So not a lot of odds that we're going to have a recession, according to the experts, yet many people think, many in the general public think that we are going to. Now, one of the things that's leading to this pessimistic consumer confidence is that renters are struggling. All right. What you can look at over on the far left, I want to draw your attention to the center where it says rent or mortgage. And you see a tiny little red line, a gray line, and then sort of a pinkish line. Well, the red line is less than 1%. And that is how many homeowners had an unpaid mortgage or fell behind on their mortgage last month, less than 1%. So we're going to talk about, are we going to have a foreclosure boom? And this is a leading indicator. Very few people are falling behind on their mortgage. But in the gray bar where it says rent or mortgage, about 6 to 7% are late on paying their rent. If you're late on paying your rent, it makes it hard to save up for down payment, makes it hard to have good credit, makes it hard to buy a new home. And that trickles over to the slide we see on the right, with home ownership actually sliding as compared to what we had during the COVID years. Home ownership really peaked in the early 2000s, right around 69%, slid through the mid 2010s to about 63% in 2016. Then we had really low interest rates for a number of years. We have a big spike of people buying homes, many first-time buyers during the COVID years. But since that time, we're seeing fewer people buying and many more people are renting. What does that mean for us on this call? If you're an investor, it's a good place to be, because these people have to live somewhere, right? So it might be a good time to buy an investment property, might be a good time to look at some passive investing, or maybe investing into some build to rent portfolios. The population's not going down, but the number of people that own homes is going down, meaning there's more renters and potentially more demand for those of us on this call that own rental properties or maybe want to buy rental properties.
And when you see all the slides that we'll go through, I think that the headwinds that are keeping first-time buyers from becoming homeowners are probably, for the most part, not going to go away. And it really pains me to see this, but I expect the number of people who rent as a percentage of all households is going to increase over time, which is unfortunate because there'll be more of a wealth concentration among those of us on this call that are investors, and less will be distributed out to the homeowners. But for the people who are investors, it's a big tailwind over the next decade.
Yeah. I wish I knew who coined this quote. I think it was one of the philosophers, maybe in Greek times. The rich get richer. And I think we're going to experience that with some of the headwinds, most notably on our next slide, student loan delinquencies. If you see that line in orange, student loan delinquencies are at the highest they've ever been. Now, they were the lowest they've ever been after the COVID forbearance pause. And during that time period, a lot of folks spent their student loan payments on something else. Those forbearance payments were hopefully going to allow you to get ahead, to stay caught up. But what we're seeing is, since those payments have been reactivated in early 2025, about a 15% delinquency on student loans. Makes it very difficult for a young person carrying student loans to save up money to buy a house. And so exactly what Lon said, that's a headwind hurting those folks that maybe want to become first-time home buyers. It's probably going to lead to more tenants over the long term.
Astonishingly, and this is the next slide, the average age of a first-time buyer on the next slide is now 40. I bought my first house, I think, when I was 27 or 28.
Yeah. I bought my first house when I was 22. It's actually one thing I do better than you, Lon.
Excellent.
Yeah.
You're better looking than me too.
No, thank you for the compliment. I completely agree. It's a little shocking to see that first-time home buyers, the average age is now 40. And I actually experience it on a regular basis. I talk to folks who are 36, 37. I have a couple I'm working with right now. They're in their mid-40s and they're buying their first home. Lovely people, very excited to buy their first home, but just couldn't get off the student loan treadmill, couldn't get off the treadmill to save up for a down payment. Now they're in a spot to buy, but it pains me a little bit to think, man, they missed out on 20 years of appreciation had they been able to buy 20 years ago when they were in their mid-20s.
If you would have bought 20 years ago, you could have bought an $800,000 house probably for like $300,000. And over 20 years, they paid off their landlord's mortgage.
Yeah, that's exactly right. And that's a big thing. And I think we've got a slide where we're going to talk about, there it is. Why should we be having conversations with our clients or the young people in our lives about buying homes? And this is the slide that I always show to first-time buyers, or if I speak to somebody and they're unsure. So we start over here on the left. We're going to look at the bottom green line. In 2010, the average net worth of a renter was $5,400. Over the coming 12 years to 2022, the average net worth of that same person, if they continue to rent, doubled to $10,400. But what if that person would have bought a home? The average net worth of a homeowner on the blue line on the left was $187,000. Their net worth also doubled over that same period of time to nearly $400,000. So I show this to folks if they're unsure about buying a home, and I say, I want you to extrapolate this for the next 10 years. You have a net worth, if you're a renter, of $10,400. If that doubles over the next 10 years, now you're at $21,000. Or if you have a net worth of $400,000 by owning a home, likely that's going to double to $800,000. So if you have a young person that's unsure if they want to buy a home, or maybe you have a young person living in your basement, Lon, you've helped some of your children buy homes. It really sets them up for financial success in the future. So I think this is a really powerful slide to share with people. If you have young people that are thinking about buying a home, or you know what, maybe you have somebody who's 35 or 40 and hasn't bought their first home yet, and they just say, well, I'm just not really sure. Show them this slide. This can be a really good talking point for folks. All right. Ooh, this is a new slide. Growth stocks and Bitcoin look expensive. I really like this slide. So there's been some mania in the post-World War II era of gold price, Japanese stocks, NASDAQ, Bitcoin you see here on the far right. These can be really volatile assets. One thing that I always like to compare against is what happens to home prices. You see that home prices go up over a long period of time, but it doesn't experience these big swings. You're exactly right, Lon. You don't see these big swings up and down. There might be a year or two here and there where home prices are down. Even this year, we might see home prices be pretty flat, but you don't see these big volatile swings like you do in the stock market or in Bitcoin. This is another one of my favorite slides. 36% of Americans still think that real estate is the best investment. I would completely agree with that. Nick, let me take a quick poll. What do you think is the best investment on this? Stocks, gold, savings? Please tell me Bitcoin. That would be awesome.
Oh yeah, Bitcoin, of course. No,
right.
It's clear real estate. I think with real estate, the advantage anybody has with real estate is obviously leverage to really juice their overall return. You know, you can go buy a $100,000 house with $20,000 in equity, and if you grow by $20,000 in equity in 2 years, you just made 100% return on your investment. You don't have that same, most people don't have access to that same level of leverage across other asset classes. So yeah, I mean, I'm a huge proponent of real estate. There's obviously immense tax advantages a lot of people get to take advantage of, especially if you're a real estate professional, that you just don't get, especially in bonds, especially in crypto, savings accounts. I mean, gold's having quite an unbelievable run. But at the end of the day, I still believe that, yeah, real estate is one of the best all-around investments you can get, especially through the 4 different points of return that you can get that you just don't have in other asset classes.
Yeah, I completely agree. I don't know any other asset class that gets you all 4 of those types of return. For those of you that have not joined us before, you get appreciation, debt reduction, tax benefits, and cash flow if it's an investment property. So I don't know any other investment class that delivers all 4 of those. And I think that's true. Looking at this chart, a wide swath of people in the United States agree that real estate is still the best long-term investment. Mm-hmm. Now let's dive in and talk about some of the trends. We touched on this already. The average age of buyers and first-time buyers is increasing. And the biggest challenge is saving up for that down payment. If you've got student loan debts, you're paying really high rent, you're having challenges making your payments, really makes it difficult to save up for a down payment. And that's what you're seeing, right? If you look at the light blue line, that average age of first-time buyers has increased, by 5 or 7 years just since the COVID years. Mm-hmm. And that really adds up, and that takes away from those folks experiencing that long-term appreciation.
We have a comment here, Joe.
Yeah.
Forrest, he's saying, I've had great success with my 4 properties over the last 12 years. He said, if I have money to invest for the next 5, I'd put it in Bitcoin over real estate. You said you wanted someone to go there, so you did it.
Forrest, diversification is a great thing. If you understand the dynamics, it might be a really good fit for your portfolio.
Yeah. And I actually do agree that there's folks that really enjoy Bitcoin investing, and I know folks that have done really well in it. We love that counterpoint. And so Forrest, call me. I'll give you a cash out refinance on one of your 4 investment properties, and you can go invest that into Bitcoin. Would love to help with that. But I do love this point of view. I do think there is some value in Bitcoin. And I think that's a really great point. Diversification. I think you should have money in probably all of these asset classes. If we were to go back a little bit here, if somebody says you should put all of your money in real estate, they're probably trying to sell you real estate. If somebody says you should put all of your money in crypto, they're probably trying to sell you crypto. I think you should be spread out across all of these classes because you never know when one of these things is going to really take off and you want to make sure you don't miss the boat. So Forrest, I love that. Appreciate the interaction because I do think diversification is really important.
Yep.
Student loans, we touched on this already. New listings. Boy, I love this slide. It's kind of a busy chart, but take a look at the far left. You see that red line. That is new listings for year to date up through February of this year. And what you see is we are right in the middle of the pack as compared to what I would say the pre-COVID years, the COVID unicorn years, and then the last couple of years that have been just a little bit of a drag on new listings. Do we have a slide for are we in a buyer's market or a seller's market? I think we're really approaching a balanced market.
It's pretty balanced. It depends a little bit on the community that you're in. The Northeast and Midwest have not had as much inventory build, so there's still a little bit more in the seller's advantage. But the mountain states where we're at and the Southeast, the inventory is built a lot faster, and it's a little bit more of a balance, or in some cases even like a slight buyer's market. Denver has, I think after Austin, more inventory build than any other large city in America. So we've had the largest pendulum swing the fastest. So it's a little softer for the sellers here than a lot of other places.
Yeah, which is really interesting. We've touched on this on prior webinars. Denver always really seems to be a leading indicator.
Yeah.
Something that happens in Denver will happen to the rest of the real estate market nationwide 12, 18, even 24 months later.
For better or worse.
Yeah, that's exactly right. Now this slide, I really like this, the lock-in effect. This is a real thing. And I want to draw your attention to the dark blue line up there at the very top. So that is the percentage of folks that have interest rates below 4%. And then just below that is the dark black line of people who have interest rates below 3%. Now, Nick, let me ask you, a couple years ago, did you ever hear somebody say, you know what, I have a 3% mortgage, I'm never selling, I'm never refinancing, I'm never moving? Have you ever heard somebody say that?
A lot.
Yes. I've got a personal testimonial. I think I've said that a bunch. So
that's true. But
Yeah.
I want to draw your attention to this black line. That black line peaked at about 35% in, I think it was like mid 22. And that black line has been sliding that now only 22% of people have mortgage rates below 3%. If all of those people said, I'm never moving, never selling, never refinancing, shouldn't that have stayed straight across, that everyone would still have that 3% mortgage? Why do you think that went down?
Yeah, I mean, at the end of the day, more time has passed, and people are moving on. They're saying, maybe I'm having a kid, I'm having my second kid, I need a bigger house than a 1,200 square foot townhome. Maybe
Yep.
I'm moving jobs. I mean, it's just the natural evolution of life moving on at the end of the day. So I'd expect that the number of mortgages under 3% will only continue to go down, for the next several years until maybe we get really lucky and go back to that time period of low interest rates. But yeah, we're going to continue to see. I think people are just going to continue to move on with life as they have over the last couple of years. And if they need to buy a house, they're going to buy a house. And that's just what it is.
That's exactly right. Life goes on. You hit the nail on the head. There was a lot of benefits to having super low rates, but if your home is too small, you're getting married, you're getting divorced, a spouse passes away, you get relocated for a job. We have these conversations every single day that, hey, I have this 3% mortgage. My home no longer serves my needs. I need to buy something. Can I get a 5%, 6%? Yeah, we can absolutely help you. And that helps ease that lock-in effect. And that's a real thing that we did see that led to really depressed listings through 23 and 24 is a lot of people were saying, hey, I'm never moving. But you know what? Life goes on. And so we're seeing that lock-in effect become a little bit easier on sellers. Marketing times. When you get more listings, sometimes can take longer to sell them. And you see the dark red line on the far left. You're seeing marketing times are right around 70 days, which is an increase of 4 days as compared to last year. We do still hear stories of homes going under contract in the first weekend, but we also hear stories of homes sitting on the market for 180 days. I have a client actually who got under contract yesterday at day 362 of his 365-day listing agreement. Now, it's a unique property. It's in the mountains. It's in Hot Sulphur Springs, but they were just about to take it off the market, and he was able to get under contract with one final price reduction.
Wow.
The important point we want to show you here, if you're representing a seller, or if you're thinking about selling one of your homes, you really want to make sure that it is parade ready. Gone are the days of iPhone photos. Gone are the days of saying, I'm not going to fix anything. Gone are the days of saying, submit all of your offers. We'll review them all on Monday. I think you want to take every showing very seriously, because you may not get as many showings as you might have gotten in past years. Would you agree with that, Lon?
Totally. Yeah, it's a nuisance because a lot of times the showing requests are on short notice, and it's not convenient because, of course, the dog just had an accident and the toddler just knocked over all the toys, and 5 other things are inconvenient, but you've just got to scramble and somehow get it happen. Yeah,
you absolutely do. That and the rise of inventory is leading to prices leveling out. Now, this is nationwide. Again, I want to draw your attention to the dark red line on the left-hand side. What you're seeing is year over year, on average, prices are down about 2% as compared to February of last year. Now, you might be sitting there thinking, I'm going to wait for the foreclosure boom and then I'm going to buy. I'm going to wait for the market to fall off a cliff and then I'm going to buy. I don't think we're going to see any of that. I think we're going to see really flat prices. In some pockets, you might see a little bit of an increase. Some pockets, you might see a little bit of a decrease. About the only thing I would say unique to the Denver area, and I think this is probably true nationwide, condos. You might see a dip in condo prices by 7, 10, maybe 12%, but I don't think you're going to see a nationwide systemic problem of reducing prices.
I've got a question here. So, Forrest, again, even if you're able to negotiate a good price on a property now, it's still tough to cash flow an investment. Agreed. What are you seeing as the best investments now? Long-term rental, multifamily, Airbnb, or anything else?
I love that question. And Forrest, what I'll tell you is my investors that are buying for cash flow, if you want cash flow right out of the gates, you probably have to put, and this is Denver, which is where I do a lot of my work, you probably have to put at least 30, maybe 35% down. Yeah. I have a lot of investors that are still purchasing with 25% down, and their negative cash flow, $200, $250 a month. I describe that as deferred down payment. What I mean by that is I'm only going to be losing $250 a month for the next year, right? And then I'm going to be able to raise rents by $200, or maybe I'm going to lose $250 a month for the next 2 years. Well, if I have to put down another 10% on a $400,000 home, that's another $40,000 that I have to put down to get that property to break even. Or I can put 25% down, keep that $40,000 in my pocket, lose $250 a month, but I know at some point in the future, rents are going to go up. $250 a month, $3,000 a year. I can lose money for the next 12 years before I would eat up that $40,000 that I'd have to put down just to break even on that. So the answer that I have is I see most of my clients doing long-term rentals and understanding that with 25% down, it's not going to cash flow great right now, but they're able to buy the property at a little bit of a discount. They're able to get some seller concessions, and they're counting on appreciation and rents increasing in the mid to long-term future. That's what I see. Lon, what do you see out there?
The Airbnb market is a little soft right now. We're seeing that there's a lot of people who've got the financial ability that they may live in Denver and they get a promotion and their new job is somewhere else, Dallas, whatever. And they buy a house in Dallas as well, but they don't have to sell the house in Denver, and they're on a 3% mortgage rate that they're really emotionally attached to. So I'm just going to rent the house out, or they put it onto Airbnb. So we've seen a huge influx of additional short-term rentals because of this behavior, and the growth in the supply side of short-term rentals has really outpaced the growth, which has been kind of flat on the demand side. And so as a result, there's a flight to quality, that there's a few too many properties. So the best ones that show the best take a disproportionate number of the room nights, and the guys at the bottom of the stack, if it's not like the nicest of the 6 that they're competing with, they don't lose like a proportional set of market share. They lose a lot of market share. So it's a very winner take all sort of environment. So if you're in a situation where the short-term rentals are such that your competitors are weak and you could be the strong one, you should definitely evaluate that. But you need to be very clear-eyed about, are you really going to be the strongest or not? The other danger is that we're seeing a lot of adverse legislation against short-term rentals. So like in Summit County, for example, Breckenridge, Frisco, Keystone, Dillon, Copper, those would be the 5 major components of Summit. There's been a lot of legislation over the last 18 months that has disallowed a lot of properties that were short-term rentals, with the goal that the people that own those properties will sell them, and then somehow miraculously a local school teacher is going to be able to afford to buy a $1.2 million townhouse. And what they've unfortunately created for themselves is that a lot of these teachers living in those $1.2 million townhomes are renting out on Airbnb several of the bedrooms. I've rented from these people constantly when I'm going to Keystone, and the only way they can afford to have that house, as they can't afford it on a teacher salary, is they've got me paying $250 a night. And unfortunately, a lot of these people are going to lose their homes. So kind of a messy time. So I would really look carefully. I do believe there's still short-term rental opportunities out there, but you've got to be really a rifle shot and really think through it all the way.
Yeah, I would add one thing to that. I definitely completely agree with the regulatory risk. The other thing I'll tell you about Airbnb, and I don't personally do Airbnb, but I have a lot of clients that do. What I've learned from them is the day you close on that property, you are no longer in the real estate investing business. You are now in the hospitality business. Yep. And that is a very different business than passive real estate investing. Now, some of my clients love it. They love talking to the people, checking them in. I've stayed at Airbnbs where the host is like the greatest guy ever, and they love talking to you and spending time with you. Cool. If you're into that, outstanding. Probably a way that you can make money if it's something you enjoy. But if it's not something you enjoy, it will not be a passive investment. There will be a certain amount of work over and above a long-term rental.
You have a new part-time job that you weren't planning on, and you better make sure your spouse is on board with that.
Yeah. Yeah. And make sure your spouse likes talking to people if you're not going to do it. Yeah. Yeah. I like what Forrest said. Once we got our systems down and great cleaners and maintenance people, it's not bad. So that's exactly it, right? You had to really get into the hospitality business. I love that. So what great feedback there. Thank you for that, Forrest. Price reductions. The number of price reductions is increasing. Again, by the way, Lon, thanks for putting all these in the same color. I like that I can spot the dark red there. Yeah. Price reductions. We are seeing as much as 15% of listings last month had price reductions. So if you've got a property and it's sitting, we get a lot of phone calls of it's priced right, but I can't get any showings. It's not priced right. You got to have a price reduction to get activity.
One interesting thing on this chart is that the number of price reductions is slightly below the line for 2025. So it seems as though maybe either the listing agents are getting a little bit more precise with their CMAs and the targeted pricing advice, and or the sellers are getting a little bit more realistic that I can't just be attached to this number. I've got to be priced where the market's at. So the number of price reductions isn't as severe as it was. It's not a huge difference, but it is a positive trend that it's a more orderly marketplace.
Yeah, I think part of it too, we're further away from the 2020 and 2021 years of people saying, well, my neighbor sold their home in 15 minutes. I want to do the same thing. That was 5 years ago. That's now becoming a distant memory. So I think that hopefully helps for listing agents when they're making their presentation to their potential sellers. So I think it's hopefully a combination of all those things, which I really agree with you, Lon. It's making for a more orderly market. This one, not surprising, home purchase cancellations are at a record high. If you look at the far right, you're seeing year to date, we're already seeing 13% of contracts are canceling, and buyers are backing out, generally using the inspection contingency. There may or may not be anything wrong with the property, but here's what we're seeing happen. Buyer goes in, they've got a high interest rate. They want to try and get some seller concessions. Maybe they get it, maybe they don't. And then they're using the inspection as a second round of negotiation, most commonly to now get our seller concessions or now get a price reduction. And sellers have been sitting on the market. They've been beat up. They finally say, enough, we're not going to give any more. And we're seeing more contracts fall out than we have seen in some of the prior years like 2020 and 2021. This 13% has been pretty common for the last 3 or 4 years. But I think I would take away from this slide, if you're under contract and you've been listed for any significant period of time, which I would describe as anything greater than the 70 days average on market, I would be very open to negotiating so you don't become one of these 13% of people that have to go back on the market. Would you guys agree or disagree with that?
Oh, that's all it right there. And there's a lot of realtors on our call tonight. So, I think it's a great slide to put into your listing pack, just as kind of an educational tool for your sellers, saying that this is what's happening. I don't like it. You're probably not going to like it either, but here's probably what's going to happen when we do get your house under contract. I just want you to be ready for it and not be blindsided.
Yep. A phrase I like to use is, Mr. Client, I tell ugly truths, not pretty lies. So here is really what the market is telling us.
Yep.
Which that actually brings up a great point. Lon, if we wanted to get copies of these slides, will you guys be sending these out afterwards?
Yeah, absolutely. You can ask Nick for it, or I believe that the people who RSVP'd and are on now, you may automatically get a link for it.
Yep. Yeah. So make sure you grab that link. We would love for you guys to utilize this information in your listing presentations. This one I really like, that the change in home prices or the change in home price growth varies by region. The Northeast and the Midwest are still doing really well. You see the South, the West, and the Southwest not doing as well. So green is good for buyers. We've had some price reductions here in Colorado. That's good for us. And the dark blue, if you're in New York, maybe it's not a great time to buy. But if you're selling, you might be in pretty good shape.
Yep.
Now, how do real estate downturns work? Every downturn ends in recovery. Seems obvious, but I love that we have a slide for it, because sometimes you think, man, this downturn is going to go forever. It always comes back. Let's look at the farther right side where you see the 2008 Great Financial Crisis. Took 4 years to really recover from that. Then we had a big slowdown at the very beginning of COVID, and we came back like gangbusters and recovered within about 6-8 months. And we're going through a slowdown now as well. I think right now our slowdown is going to be longer than we had predicted. I think if we went back and we watched these recordings from 2 years ago, I think we thought we would already be back to more appreciation. I feel like we're at the bottom and beginning to climb out of this downturn. What do you guys think?
It's going to be a long, slow grind. We're moving in the right direction. I think we're past bottom dead center, but it's just going to be a very slow comeback.
Yeah, I completely agree. So you might tune in 3 years from now and we're back to where we were at back in 2022. Doesn't mean that there's not good opportunities out there, though. I think there are still a ton of great opportunities. I love this slide. This isn't the first slowdown. Sales always come back. And you can go here and look. What were the mortgage rate trends in the early 80s? You saw interest rates went up and then down. During the 2008 and 2020 crisis, you see that rates went down. And currently, a big part of what's driving the slowdown is the increase in interest rates. It's now been 4 years. It was March 15th of 2022.
Yep, it's the 4-year anniversary.
That's when interest rates crossed 4%. So interest rates of 5, 6, 7, 8% became the new normal for a while. I think we have some slides in here. We're going to talk about it. Interest rates currently right around 6 to 6.25. We had a brief blip below 6% a few weeks ago, but I think we're still in a very good time for interest rates that buyers can still get good deals and have a reasonable interest rate. We're not talking about 8. We're not talking about 3. 6% is very reasonable to own properties and make real estate wealth. Are prices going to drop? Let me take a straw poll. Lon, are prices going to drop?
Condos, probably. Houses, probably not, although some neighborhoods will see different performance.
I completely agree. Nick, what do you think?
Yes, modestly. I would agree. I think condos will. I think, if multifamily could continue to go down a little bit, but I think we'll probably be more stagnant overall for the foreseeable future.
Yep.
I completely agree. And here's all the slides that are going to show you that. One of the big things is the home price to income ratio. It now takes more than 5 times the average income in order to buy a home. It means that homes are really expensive relative to incomes. That makes it difficult for us to have a really big increase in prices. But I don't think we're going to see a lot of prices really sliding. Monthly escrow costs, this one blew me away. Monthly escrow costs on average are now almost $700.
That's crazy.
We actually see that here. I mean, I'm seeing homeowners insurance, $300, $400, $500 a month. I'm seeing property taxes have increased steadily.
Yeah.
I think the average property tax I see now is $350 a month. And this makes it more difficult for buyers to qualify.
Mm-hmm.
And 22 of the 50 largest metros have experienced falling home prices. Denver, we're over to the right. You see, we've lost about 3% from September of 24 through September of 25, which is when this data was compiled. A 3% decrease in home prices. Is the sky falling, guys? What do you think?
No, but it is a little disappointing that you got a negative trend in so many different metros.
Yeah, I completely agree. The sky is not falling. A 3% reset does not mean the end of the world. We're not going to have a foreclosure boom. Might be some good opportunities. And then home affordability is a good balance. And what you see is we had many years when that orange line was way outpacing the blue line. 2025, we finally got back to where incomes were growing faster than home prices. 2026, I think, is going to be another rebound year for wage and income growth. That's going to help reset the scale and make it easier for more people to qualify for the average home. This one I love. Prices are forecasted to increase 1.6% in 2026. So over on the far left, the large orange bar, you've got the National Association of Realtors. They're always optimistic, love them to death. They think that homes are going to appreciate 4% over the next 12 months. Over on the far right, the Mortgage Bankers Association, they think the sky is falling. Homes are going to lose prices. Interest rates are too high. It's the end of the world. I love the dichotomy between these two. On average of all of these, Cotality, Wells Fargo, Bank of America, Zillow, 1.6%. I agree with that on the aggregate. Back to what Lon and Nick said earlier, I think condos, you're going to experience some price depreciation. Homes, you're going to experience a little bit of appreciation. It's going to average out to maybe 1.6, 1.7% over the next 12 months. Sales volume. This one I disagree with. 2024, we sold about 4 million homes. 2025, we don't have the final numbers yet, but they believe it's going to be about 4.1 million. And I believe this is from National Association of Realtors. Again, they're optimistic. They think there's going to be a 10% pickup in transaction volume, and we're going to close 4.5 million sales this year. I think that is optimistic. I don't see it either. Yeah. Now, for real estate agents on the call, does that mean that you should just hunker down and you're not going to close anything and just live on your savings? Absolutely not. I completely think that you can outrun the market. I think through good prospecting, good presentations, good coffees, and making your forward calls and calling your database, you don't have to be flat. You can absolutely close more deals. It's easier than you might imagine to outrun the market. And I can give you all sorts of stories about that. But let me ask you, Lon, do you think this could be a good year if an agent is doing all the right activities?
Every year, always, is a good year for the agents that are on top of it. I'm always impressed by that.
Yep, I completely agree. Debt to income ratio, we've touched on this a little bit with affordability, so we'll kind of keep going here. Affordability, again, buying conditions have improved, right? You want to see homes to be affordable. They need to be below that red dotted line, meaning that we're using an average of 30% of your income or less to afford your home. That kind of peaked in late 2023. Makes sense. Interest rates were almost 8%. On average, it was costing 38% of someone's gross income for them to make their home payment if they were buying a home at that time. That's come down as prices have flattened out and as interest rates have generally decreased. We're seeing we're approaching that more affordable level of 30%. What remains to be seen is, will we get there if interest rates continue to come down? Maybe, but I'm not super optimistic that we're going to see very low interest rates over the next 12 months. Real estate recessions generally do not lead to declining real estate prices. I love this slide. On the left-hand side, you've got the last 6 recessions. The only time there was a massive decrease in prices was the 2008 recession. that recession was caused by a decrease in real estate prices. Recessions do not cause home prices to go down, as you can see, for 4 of the last 6 recessions. And even 1991, that 1.9%, I think, is a rounding error. I agree. What recessions do lead to, though? Reduced interest rates. All of the last 6 recessions, we've seen interest rates improve anywhere from 1 to as much as 5 points. I would throw out the 1991, 81, and 80 recessions. Interest rates were 17, 18, 19%. They had a lot of room to improve. If we do happen to have a recession, I think we're going to be further over to the right, where we'll see interest rates improve by 0.7 to maybe 1%. But we touched on earlier, I see very low odds that we're going to have a recession, even though the general public thinks or / is optimistic that we will have a recession. I don't think we're going to. Is there going to be a foreclosure boom? We've kind of touched on this, but I love this slide. There's not. 0.13% of homes are in the foreclosure process. 0.13 homes. So if you think about that, if there's 1,000 homes, 1.3 of them are currently going through foreclosure. Now, what you might see are some headlines that say foreclosures have doubled, because you go from 1 home that's in foreclosure to 2 homes that's in foreclosure. Yes, that's a doubling, but that is not enough to move the needle or cause any sort of disruption. Specifically, look at Colorado. We are one of the lowest here in the United States at 0.1% in foreclosure. So if you're waiting for a foreclosure boom, or you have young people saying, I'm going to wait for the bottom to fall out of the market, that's what I'm going to buy, you might be waiting for a long time.
I don't see it. None of the dynamics that we had in 2009 are being repeated here.
Yeah. And this slide touches on exactly that. Look at the housing bubble, where we had this big run up in equity. Then home prices began to come down. The aftermath of the crisis, there was actually more debt than there was equity as a nation. Go to the far right-hand side. We have more equity than we have ever had in the history of the United States.
Insane how much equity we have.
Yeah.
I just don't see how people like go into foreclosure when they're sitting on $600,000 worth of equity in their house. They're going to call one of the people on this call to sell their house, and they're going to walk away with $500,000 and move on to the next chapter of their life.
That's right. And 40% of homes aren't even eligible for a foreclosure. 40% of homes do not have a mortgage. So to think through, what was that like back in 2008? You can see it it's very difficult to read, but in 2010, only about 33% of homes were paid off in full. So that
2009, I'd imagine, or 2007 probably would have been the high 20s. So the number of people who've been paid off has really increased a lot, which is very impressive. Considering that people could have borrowed at 3% and put it in something else as an investment. They didn't do that either.
Yeah. I think a lot of people learned a lot of lessons. You know, we have generally short memories, but I know I learned a lot of lessons through 2008. I think the general public learned a lot of lessons. And as a nation, I think our economy is pretty darn good.
Oh, of course it is.
Particularly the real estate economy that we're focused on this evening. All right. We talked about this. We have more equity than we have ever had. Home mortgage debt is higher than it was during the great financial crisis or prior to the crisis, but as a percentage, the nationwide loan to value is very, very low. We are not going to have a foreclosure boom. And we touch on just a little bit here of negative equity. It is concentrated in a few markets, mostly Florida, a little bit in Texas. We have a little bit of negative equity here in Colorado. So this is saying 4.2% of homes potentially are upside down. That would be folks that bought within the last 3 years using FHA or down payment assistance and didn't make a very big down payment. They haven't had time to experience that appreciation. They haven't had time to start paying down their debt. But most of those folks are current, as we saw a few slides ago, that the foreclosure delinquency rate is 0.13%. Very, very low. So we're not going to have a foreclosure boom. If you're hoping for one, sorry to deliver the bad news.
You'd have to go to South Florida.
Yeah. And then despite all of the headwinds, this is the slide I'm really happy that we're ending with. No matter which way the real estate market is leaning, a lot of folks still want to become homeowners. Do you have plans to become a homeowner in the future? 32% of renters said yes. Within 2 years, 27% said yes in greater than 2 years. And so 39% of folks said no or unsure, meaning that, what's that? 60% of people still want to become homeowners. So
Yep.
despite all those headwinds, I think this is a very optimistic slide. Makes me feel good about the way that our general public is moving. Would you guys agree with that?
Yep.
Yeah.
And for all the realtors on the call, if you've got, people who are potential first-time buyers, I definitely stay in touch with all of them. And you might ask them, for your family, what's going to be the catalyst to make this happen? Is it getting student loans under control? Is it saving up a down payment? Is it that one of you looks like you might have like a big promotion coming up in 2 years, you'd have to relocate, so you don't want to buy a house now? But I think if you could find out the why that's holding them back, and then explore the dream question of, is it in your family's goal someday to have a house, and what might that look like, and how would it be different than your lifestyle right now? You can really learn a lot and be a more valuable consultant to them.
Yeah. As we wrap up, guys,
If you want to talk to me or to Nick about your real estate situation, we're always glad to help you with that as well.
Mm-hmm.
outstanding.
And
All right.
Joe, if you've got someone who wants to do a refinance, is it a hard process? What's involved in that?
It is not a difficult process. Right now, we have a ton of folks refinancing. I'll give you guys a quick example. I spoke with a client about an hour, well, I guess now 2 hours ago. It was about an hour before we started. Helped them with a new loan 3 years ago when they bought their home. We're able to reduce their interest rate by 1.5%. We're saving them about $700 a month. No appraisal needed. I just need copies of their pay stubs, W-2s, bank statements, and we're going to close their transaction in 2 weeks. We also have opportunities to take cash out. Sometimes you'll need an appraisal, sometimes you will not. But I have another couple of clients taking out anywhere from $50,000 to $100,000 and looking at reinvesting that money into buying rental real estate. So right now, lots of equity. Rates are the lowest they've been in the last 3 years. Lots of folks have jobs, lots of opportunities to refinance and improve your situation. If you would ever like me to review your portfolio, would love to chat with you about that. I've got several investors I'm working with right now who are taking out several $100,000 to buy more properties, all because we had a portfolio review and they said, man, I've got some dead equity. What can I do with this? Something that I love looking at. Nick, I know you do a lot of those calls where we review folks' portfolio and figure out, hey, let's get $50,000, $100,000, $300,000. There might be an alternative way to use that money. So would love to chat about that.
Yeah, and I'll give you an example here. I just chatted with an investor last week. I think rates dipped right down to 5.99. Was that last week? He immediately,
2 weeks? Yeah. It was
got
right
about
before
2 weeks
the war.
ago.
he's got $1 million property. He's got $100,000 left to pay off on it. He's not planning on selling it because of just the market that it's in. He's decided that he's going to refinance down to the 5.99%, pull out $400,000. His cash flow is going down a little bit, but he's taking that chunk of cash. He's putting it into an income fund at Ironton Capital. And so that minor loss of cash flow is being subsidized by, let's call it about $50,000 in annual passive income through the income fund. So it's very unique. He was evaluating, do I do a HELOC or do I go the refinance route? So, in that case, it's just a great example of that if you have a low interest rate, it's not necessarily a terrible idea if you've got a ton of debt equity to refinance, even if your rate goes up. There's still opportunities to take that lump sum of cash, deploy it appropriately to help subsidize or even improve your cash flow. So don't be afraid, at the end of the day, if your interest rate is going up just a little bit, there are other opportunities where you can potentially make more money by doing such a move. So that was a really great case study that we just had, over the last couple of weeks.
It's kind of the classic case on how banks make money, because he's taking out a $400,000 incremental loan at a 6% rate. Investing with us, he's getting paid 12%. So he's making 6% net after all of his expenses. And I'm not totally up to date on all the tax laws on second mortgages, if that'll be a deductible thing for him or not. I don't think it is. But even if it's not, he's making an extra $24,000 a year for doing nothing, which is fantastic.
One of my best friends taught me a quote that empires are built on a 3% interest rate spread.
Yes.
So it doesn't have to be a big spread, and it can be very, very valuable.
Yeah, you know it.
We did have one question, Lon. I think we'll throw this one to you. Any thoughts on ownership pressures from tenant-favored rental rules in Colorado?
Yeah, there's been about a dozen pieces of legislation over the last 36 months in Colorado that have all been anti-landlord, pro-tenant, making it more difficult to do business in the state. And there's a number of proposals underway right now in the local state legislature that are all, again, pro-tenant and anti-landlord. So the feedback I've gotten, I've had 20 years of teaching people how to become landlords. A lot of them did. And a lot of them, they've had 5, 8, 20 years of huge appreciation. They're sitting on a lot of equity. And they're discovering two things. The amount of cash flow relative to the gigantic amount of equity in the property, it's a very small number. Usually it's like around 6% is what we usually find. So they could sell the property, even if they paid taxes, and redeploy and make a lot more money without the headaches. And the second is they're just really fed up with all of the new laws that are anti-landlord. And there doesn't seem anything stopping the state from implementing more laws. And just out of frustration, they're saying, I just want to do something else. So that's been a huge part of the growth for us at Ironton, is just giving people another alternative that enables them to be passive, get a lot more diversification, spend more time with their family, and not have to deal with legislative pressure.
Yep.
Completely agree. The other thing I would say, if you have rentals, have a good property manager. My property manager, he's worth his weight in gold.
Yep. Absolutely.
Yeah. Well, gentlemen, thank you so much.
Thanks, guys.
Really appreciate you joining us. All of our attendees, thank you. Thank you for the engagement, for the questions.